In this episode, Jake and I discuss single premium non-MEC policies and how to get a relatively substantial amount of premium into policies rather quickly and correctly. We had fun and hope you enjoy listening. I think the insurance companies are just putting these products together to, fill the perceived need of the marketplace. Yeah. Right. And so when you have agents that sell them and promote them and people that buy it, that's a signal to the life insurance company that, we can make money on this. It's a good product. Let's, internally, what happens even in a blended PUA because of the rising cost of term. And when you see what's going on, if you would have known better or would have known different, you would have done something different, in my humble opinion.
I could be wrong. No, a lot of those blends to me more resemble a UL, universal life policy, than they do traditional, or what I would call level premium whole life insurance. Yeah. So level premium whole life insurance, not saying you can't raise and lower premiums, just the costs aren't going to raise and lower on the PUA, the term, the base. None of those internal costs are raising. So level premium, and that's the effect of it. Is it's a level premium. What you can pay, that maximum premiums level. It's not going to increase in the future because of a term cost internally, like with whether a 1-year renewable term or Universal Life would call a cost of insurance, a COI. So, but they function very similar to me because the problems are very similar. Not only the possible eating of current cash values, but possibly the raising of premiums, possibly the surrender of policies. What happens when I'm 20 years out into a policy, I'm max loaned?
How about I'm 60 and I'm not max loaned, but I got an IUL? How many of them do you want to deal with?
None, but specifically in both of these cases and scenarios, whether it's the IUL or it's the blended term, if I'm at let's say age 60, let's say I have, a lot of my outstanding loans, already, going. So I've taken a large amount of my, available loans. So I've already used those. What can happen if that cost goes up and it's not covered by the dividend, or just the COI, the cost of insurance, and a UL goes up? Yeah. Couple of things, right? If that difference can't be met by the dividends or the earnings of that, side account, right? Either you're going to pay for it, and if you can't afford it, it's going to surrender PUAs. Well, what if you don't have the PUAs to surrender?
Yeah, in the IUL policy, it would be surrendering the account value.
Same with a whole life.
Same thing. It's surrendering the cash available.
In a whole life, maybe it would turn into a MEC instead because you'd have to drop the term. It would reduce. That could cause a MEC. But a UL, it's more than likely just a straight up surrender. There's not too many options that you can really throw into effect.
There's really a lot there because, and I would say with the UL, which I was talking, we had some home office professionals in the office yesterday, and we were talking, and that particular company, I don't think they have IUL, but a lot of the agents they recruit, and they mentioned a big IMO, independent marketing organization, and he said they had 30,000 agents, right? So the IMO is great at contracting, but there's no training. Yeah. And I'm just bringing it up to what I've seen lately with IUL marketing is like, oh yeah, you can practice the infinite banking concept. They love to bastardize Nelson's work and say, no, you can do IUL. And the people who don't like IUL, yours truly, don't know how to structure it correctly, which, they've even taken that argument from the infinite banking footprint argument of 10 years ago. Yeah. No, it's properly structured.
There is no proper structure with an IUL.
You can structure them where they won't cannibalize illustrated, until much later. But like what you're saying, as the cost of insurance goes up, what's going to happen? Either that policy is going to begin to cannibalize itself, and then if you already have outstanding loans, which is what that mindset does, it's going to ultimately wind up in surrender, which I believe that is the ultimate result.
And 20 years out, that's also a taxable event.
Yep. And then I like these people that, I love the people, the situations that they were put into and bought into. It's not all their fault. It's not all the agent's fault.
Yeah.
But I'll heap it up on the agent because they should have known better. They should have learned their product. They should have, could have, would have, whatever.
Yeah.
But if you're going to present yourself as a professional, then, you should have a certain level of knowledge in whatever endeavors you're doing. But these people, they have the 90-10 or this jankily structured policy, honking outstanding loans, and now let's get to that tax-free income in retirement that I bought into 15 years ago. Yeah, and you have an outstanding loan. Okay, that policy is going to cannibalize anyway if you don't repay the loan. If you do repay the loan, it's going to cannibalize sooner or later than if you didn't, but it's not going to produce supplemental income.
I could have no outstanding loans and I get into my let's say age 65, and now I want to start taking, loans from my policy to supplement income in retirement, passive income. You can't do that with an IUL. You can't do that with if it currently has a blended term on it. And the reason for that is because as you start taking out loans, right? Those policies are already cannibalizing themselves at that point, or very close to doing so. And so you have two numbers that are essentially meeting much quicker, which is the outstanding loan and then the cannibalization of the policy. So as your cash values go down and as your loans go up, eventually those numbers are going to meet. And that's a taxable event when those numbers meet.
That's going to happen more likely, in my humble opinion, in an IUL.
Yeah,
with
I agree.
The blended PUAs, depending on what the client has done, and I'm not trying to put an onus on the policyholder, but they do have a part to play, right? And it's what they've done, because what you do as a policyholder has a greater bearing on the results of that policy than what the life insurance company does. And that's almost a modified quote of Nelson Nash, and it's absolutely true. But with a blended PUA, that could occur, but it's going to be out further.
Yeah. It's more for older clients who are buying policies when they're older, doing the blended terms when they're older, maxing out loans, not repaying things.
In the blended PUAs and they have these honking outstanding loans.
Yeah.
You've got to do some legwork.
Yeah.
Right. To make sure those train wrecks don't happen. And then you're limited on what you can do. Take an IUL that maybe has a $2 million face amount, whatever the face amount is. The company's going to restrict how much you can reduce that face amount.
Yeah.
And because if you reduce the face amount, then you're trying to mitigate the cost of insurance, increasing, compounding, exponential curve, increase cost of insurance. So you're trying to mitigate that, right? But they limit that, because they have the equivalent of MEC testing, CVAT. You're just limited on what can be done, because I have older clients, they have UL policies, I inherited them, and what the management is of the policy is how to avoid losing that $75,000 you've paid in premium over your lifetime, right? And then if you carry it out to natural mortality, you're going to ultimately pay in $95,000 to this policy, and the death benefit may or may not be $95,000 or $100,000. Right. So all you're doing is protecting the money, not protecting, you're trying to get money back that you paid in.
Yeah.
So, and I know every situation is different. Okay. I don't want to chase a bunch of rabbits, but it's the idea of a MEC. Okay. Today, lump sum, it's taxable. The ability exists with good companies and good products that you can lump sum a premium or one time a premium and have it structured where it's not a MEC and it has its outcomes. Yeah. Maybe limited loan ability in the first year or two compared to what you might want to do. But if it impedes what you want to do, then it's not necessarily the best solution, right?
Yeah.
And however, I believe working with a competent agent advisor, you can achieve whatever it is you want to achieve and enjoy all the benefits of life insurance.
Yeah.
Practicing the infinite banking concept. Okay. And I know we've gone a long time, but the idea that we also talked about in this conversation front loading, quote unquote, maximum premium in the early years, avoiding the MEC, and some of the things that occur out there that just kicks the problem down the road, which can be avoided. But there's also the ability, I don't think too many people are aware of it. I don't know. I don't listen to a lot out there in the big wide world. But there is the ability, let's say you've got an older policy, you've been paying, $5,000, $2,500, $10,000 a year, whatever the premium is that you've been paying, and now you're tired of paying premiums. I don't want to pay any more premiums, I don't want to pay premiums. Well, in the IUL policy, you don't have the non-forfeiture options like reduced paid up to make the premium go away. Your financial guru can run the illustration of vanishing premiums or whatever terminology they use. That's just going to cause that IUL policy to cannibalize sooner. Okay. But with a dividend paying whole life issued by a mutual company, there is the ability to 1035 exchange a policy into a single premium non-MEC policy.
Yeah.
And there's requirements and parameters, it has to have enough death benefit and all of those things, but it can absolutely be done.
So if I have like an IUL policy that I'm now learning is just not going to work for me, or I'm getting illustrations from my, CPA or whoever is, help me write the policy, whoever it is, your agent, whatever.
Well, your CPA is liable to still be in business.
Yeah, true.
I'll quit. Or I won't get started.
But look. Let's say that's exactly what's going on. Like you're seeing illustrations that your policy is going to cannibalize in a couple of years or in 10 years or something. You don't want that. Could you take that IUL policy and do a 1035 exchange into a single premium? So I'm not paying any premiums here, right? I'm stopping my premiums. I don't want to do this anymore. This is not good for me. I don't want it to run out, so I don't want to have no death benefit when I die. Or I want, still have access to my cash value.
Yeah, maybe your circumstances change. It doesn't make sense for you to continue paying a premium.
Absolutely.
You don't want to continue to pay premiums.
Yeah, maybe you just have another whole life policy, right? And you have to pay premiums for the next 20 years and you don't want to. Could you 1035 exchange that policy into a single premium policy? It'd be a non-MEC. And you to be able to still use it like an IBC policy via loans, via supplemental income, however that is. The answer is absolutely you can.
Yeah, I like that. The idea of an IUL going, that's really could be appealing, right? Because you can see that it's going to, or you suspect it's going to cannibalize itself, and or you just don't want to continue paying premium. Yeah. So you want to preserve as much capital and death benefit as possible. And there's no non-forfeiture options, right? With all UL policy. I don't care if it's a VUL, an IUL, or the old just ULs, if they still exist. And I'm sure some company out there somewhere is still writing them. And I'm sure people are still paying. They're just holding on. The problems, right? The cons, you still have to be insurable to get the new policy, right? So, and if you're not, then what do you do? Then you manage it to preserve it the best you can. If you have older whole life policies that you don't want to continue paying a premium on, they have non-forfeiture benefits. I can elect, guaranteed contract, reduce, pay up the policy. I'm going to reduce the death benefit. The policy's paid up. I still have cash value. I still have loan provisions, but I cannot pay another premium.
Yeah.
So then you're just preserving the values to the best you can at that time. Yeah. So that ability exists with whole life that doesn't exist with universal life, but that would then therefore maybe be a comparison. It's like, hey, Jake, I've had this policy long time. Maybe the company's demutualized and sold out to a hedge fund, a Canadian, private equity group. I don't know. I'm not naming any companies, but that's happened recently, relatively recently, and it's subject to happen again if you look at what's going on in the life insurance world. Anyway, I want to avoid all that, right? Yeah, don't want to RPU, reduce pay up, elect a non-forfeiture option with a company that is now owned by a hedge fund. Hey, not really. Not if I'm insurable, right? If I'm insurable, maybe I want to preserve that capital and maybe have it grow, and I can enjoy future passive income, and I can leave a tax-free legacy. And
I've seen certain policies as well that they would MEC if you were to RPU it. Like it just cannot happen. It can't happen.
Question.
And if you're also, so once a policy is a MEC, it's a MEC, and you can't unMEC a MEC. A MEC is a MEC, right? A MEC is a MEC is a MEC. However, if maybe you receive, some sort of letterhead from your insurance company saying, hey, if you pay this next premium, it's going to be a MEC. Or you're seeing if I'm going to RPU this policy, it'll be a MEC. I could then 1035 exchange
before the MEC
occurs and keep it as a non-MEC status. So
what?
Again, and you can do this via paying, more premiums and continuing to pay premiums. You can also just tap out and just be like, hey, I don't want to pay premiums.
Well, you can't do this specifically, 1035 exchange from a non-MEC policy, single premium into a non-MEC policy. You cannot add new money to that. You cannot add new money.
It's done.
Because then if you
But a regular 1035 with a regular policy, you could.
If I'm just replacing an old policy for a new one?
Yep.
Yeah.
So, or maybe I'm paying too much premium. I feel like I'm paying too much premium. Let's say I bought a policy from an advisor and he had me pay $100,000 in year one and $20,000 a year after that. I can't afford the 25. I can't afford the 20,000. I'm in year 3. I've paid the first 2,
well, how about
maybe even
we
3 years of premium.
Have the dividend to reduce the premium.
That's,
I'm just saying
that's possible, but maybe it's not enough. Maybe I need to pay closer to $10,000 in premium.
Maybe I do, but my point there is you have that contractual right with a mutual company that pays the dividend.
Yeah.
Even a stock company that pays the dividend. I have the dividend to reduce the premium, right?
That's legitimate. You can do that.
Yeah, and then what you're doing from that point forward, you're retarding the performance of that policy.
Yeah, absolutely.
Because now the dividend is not buying additional death benefit.
It's much less efficient, for sure.
It just lessens the efficiency of the policy. So, and I'm not trying to play devil's advocate that harshly, but yeah, I am, because if you don't know what you can do, and your agent or your advisor doesn't know what they can, I'm sure there's somebody higher up in their IMO that can teach them how to sell you something.
Yeah.
All that exists. But whenever you have in my humble opinion, a policy with a legitimate mutual company that has the proper philosophy, and yes, it's important. Just go marry somebody who's got an opposite philosophy of you. I'm not saying you should marry a life insurance company, but it's a long-term endeavor here.
That's what it is.
Long range. I'm gonna throw a bunch of money over my whole lifetime into this company, and their philosophy doesn't match mine. I say that because there's y'all who's out there that try to crack on me for using the word philosophy like it may be important. Yeah, hell yeah, it's important.
It's super important. And maybe one of the most important, if not the most important thing, is a shared philosophy between what you're trying to do and what your company allows. If the company is not going to make it easy or make it difficult for you to do what you want to do, that's a red flag. Not just a red flag. I mean, you are literally taking a square peg and trying to fit it into a round hole. Can you do it? Maybe with a hammer and a chisel, you can get it done.
It's going to be ugly, but it can be done, right?
Yeah, I mean, but then it's no longer what it was, right? Because the square peg is no longer a square peg. You had to shape it into the round hole.
I just knocked the edges right off. And some people need the rough edges knocked off. No question. I agree with that. But look, maybe I'm fiscally conservative. And then I'm going to go do business with a company that they have the complete opposite philosophy of that.
Yeah.
Yeah. Okay. Yeah. I'm not. Yeah. No. So philosophy does matter. And then if they have an aligned philosophy, they're likely going to have the result of that, which are going to be their financial activity.
Absolutely.
Right. And then that's also going to affect their product availability. Do they have 2 policies that are available and everybody's got to fit within those 2 policies? And if they don't, then the advisor's got to mutilate the structure to make them fit. Or there's a company that has multiple offerings, right? Well, why would they have multiple? Because not everybody's situation is the same. And now there's less, I've got to make a square peg fit in a round hole. So philosophy, I think, is important because it does speak to everything else. Product design, financial philosophy, financial activities. And so.
Look, I hear this from agents, and especially maybe I've heard less of it recently, but there's still companies that like are direct recognition companies. And what you'll hear philosophically is once you have this policy, don't loan from your policy. Take that policy down to the bank, collateralize it.
Oh, yeah.
And then, use the loan from the bank to do that.
Yeah, because interest rates are low. And yeah. It's just, there's some companies that, in my humble little 35-year career, there's a few companies that have been known to quote unquote train their agents as just a matter of their training, course of training, which most companies don't have training today. But part of that training was for the agent and the advisor to go and formulate these relationships with bankers to do that. Yeah. Right. So we're direct recognition. We pay a fair dividend, but it's going to be reduced on an outstanding loan. So, okay, you don't have to take that reduction. And if you go collateralize that policy with a third-party lender, which is one of the worst things you can do if you're going to practice becoming your own banker, in my humble opinion. Yeah. Why? Because anything you do with that policy, you're not going to borrow against that policy if you had to. And I get the purpose was you're not going to. That's why you went to the third-party lender. You can change beneficiaries. You can't change ownership. And you're not going to go get a loan without that third-party lender's approval. You're not going to change a dividend election without that third-party lender's approval. So you're telling me that's how you become your own banker? Yeah.
Surrender the ownership, give the ownership to somebody else. Yeah. That's a great
you're not
idea.
really surrendering. No, you're collateralizing it, but you're collateralizing the policy for the loan, right? From the third-party lender. That cash value is only part of that contract. Right. So just think about this. Somebody, I'm just collateralizing, the cash value. I'm just borrowing against the cash value, and I'm just collateralizing my cash value, even with the company that you own and you're borrowing their money. When you take that policy to a third-party lender, you're collateralizing that whole contract. Every right and privilege the owner has is collateralized to that third-party lender. And now in most cases, that may not be a problem. Maybe it's a short-term loan. What if things were different, they'd be different, right? But no, there's more value to a policy than just the cash value. Now, that's important, especially if we're going to practice the infinite banking concept. I agree with that. But let's say, let's say I get into quote unquote retirement. Okay. And I'm going to go collateralize this policy because unwinding a business, whatever the case may be, I need that third party loan. And that's the best collateral that I have is this life insurance policy. But now I want to take income from that policy. Maybe I just want to take the dividend in cash. Maybe I, want to do a loan every year to supplement my income. Maybe I want to set that up automatically if I can. That is not going to occur without that third-party lender's approval. Yeah, because you collateralize the whole contract with them. Anyway, I could continue. That's what this is kind of why it's difficult for me to sit down unless I have everything point by point and this is the only thing that we're going to discuss, because there's so much more than any one point that you want to talk about.
Yeah. Everything has a rabbit hole that you can go down. And
I love the idea though. I'm not tired of paying premiums.
Yeah.
Do I have to struggle sometimes and move money or whatever, sell something? I'm not opposed to that. I haven't had to. Have I had to collateralize from, have I had to collateralize, get a loan to pay a premium before? Yeah, I've done that. I'm not promoting that. I don't think you should do that. I don't think you should put yourself in that position.
Yeah.
Yeah. But I have that contractual right. Right. So, I've done that. I've done the cash out refis to pay premium. I've done a lot of things. The main thing I've done is worked really hard and provide a good service to our clients. Right. And I'm not going to change that. And here where I'm going with this is I'm just saying I'm not personally tired of paying premium. I can't wait to buy the next policy.
Yeah.
Right. I'm continually going through underwriting. I'm dragging my wife through underwriting because after, I think the oldest policy that I have is 2005, I think.
Okay.
All right. Maybe 2006, but I think it's 2005. And that was several policies ago. We own our fair share. I don't think it's a number game. Like, I own more policies than you, so I'm better than you. I think
I do own more policies than you, so I am better than you.
No, I'm joking. That's a game. But
yeah, absolutely.
That exists in the mind of some of these practitioners or people who, say they practice the infinite banking concept.
Yeah.
My point here is I'm not tired of paying a premium. I'm looking forward to paying the next premium on the next new policy. We pay a lot of premium. We make our loan repayments, but if you are tired of paying continuous premiums, there could be a legitimate solution for you, whether it is to take advantage of the contractual rights that you currently own or 1035 exchange that, because you can go through underwriting into a paid up single premium policy that is not a MEC. And as we were talking, earlier in this week that we should sit down and talk about this, it just occurred to me and you too before. It's like nobody really talks about that. The focus out in the big footprint is, how to get all that money in and contorting these policies.
Yeah.
Which those are really new policies, right? Anyway.
But no, that's something I've seen quite a bit too, is, people calling in and maybe they have a policy with somebody else and with another insurance company, and they'll say, Jake, I'm paying, $20,000 a year and I can't afford that.
Yeah.
And it's like, and this $20,000 isn't very efficient. And when I look at the policy, it's like, it looked great up front, but, the further I look out, it's just not very efficient. I've seen other illustrations that are a lot more efficient. What's wrong with mine? What can I do? It's like, well, let's start first. What do you want to pay in premium? Well, I want to pay about half of what I'm currently paying premium.
What can you do? You can't do that where you're at or whatever.
So you can do a 1030. If you're insurable, you can do a 1035 exchange. Essentially, it's not the best situation and solution for everyone, but look, if the choice is, surrendering the policy because I can't pay the premium, or 1035ing your policy into a, lesser premium policy, do the lesser premium policy. Yeah, you're starting over, but you have the cash value from the first policy that you're essentially transferring to the second policy. Then you're not
starting over if you have cash value that you're 1035 exchanging.
Yeah.
No, because of the, so I'm just saying
you're not truly starting over.
No, you're not continuing where you were. There's a change, but you're not starting over because those values and the basis transfers too. It's far from starting over.
There is still the loss of liquidity. You can't jump over the loss of liquidity in year one. If I have $1 million in a 1035 exchange and I send it to an insurance company, I'm not going to have $1 million in cash value year one.
Yeah.
There is still going to be the loss of liquidity years 1 and 2 and 3. So you, in essence, are starting over on the loss of liquidity.
Yeah,
so you
and the whole idea of this, I want to, to me, in my mind, that's an adjustment.
Yeah, I agree.
You did something based on the information or the knowledge that you had at the time. The future is unknown, and you did your best with what you knew, even in the face of the unknown future. But then things change, whatever those were. Maybe it's your fault. Maybe it's not even trying to assign fault.
Yeah.
Things have changed, and here's where you're at. And it doesn't make sense to continue where you're at, right?
Yeah.
And so
you oftentimes have a lot more options than surrender.
Yeah.
And that's, I think, the most frustrating part is when people consign themselves to well, this didn't work, I'm going to surrender the policy. It's like, and then do what?
Yeah.
And do what? How many years have you spent, I'm
going to go buy Bitcoin.
Yeah.
Make up for it. I don't know.
People get desperate and do desperate things. And look, desperate reeks no matter where it is.
One thing too, and I got to say, we've got to be very clear that that's not our mode of operandi.
Yeah.
That is not, we don't.
Replacement, yeah.
No, not interested in replacement. If it's bad, it's bad. But if it's not bad and you can make it better, make it better. Don't,
Yeah.
The replacement game is, I'm not interested. But however, sometimes that makes the most sense. And when it does, it does. But if it doesn't, don't force it. It's not the square peg in the round hole.
Yeah.
I was going to say, I don't know why, but I don't know why I thought about it, but you base things, make the decisions based on what you know and what you understand and what you're comfortable with and what makes sense. And then as things change, there may need to be an adjustment, which is natural in all of life.
Yeah.
The obverse of that, like I said earlier, I've worked with a lot of agents, continue to work with a lot of agents. And when they don't make it, if they don't make it, we're not going to orphan their clients and policyholders. So we step in the role and provide the service that one would expect. And some of that, the obverse of this thinking, some of these policyholders, whether they didn't understand, whether they were drug into it or what have you, it was difficult for the original agent, to drag them in, right? And drag them around. It's probably why they're not agents anymore. I don't know. But over time, most of them are like, oh my gosh, I see where I had failed or what I didn't do or what I should have done. What can I do now to make it even better? So there is the opposite of, which is pleasant, to see people win. I like seeing people win.
Yep.
So I just thought about that because
I'll say most times when people do the infinite banking concept, they do win. Of course, I think oftentimes for agents, advisors, whoever, the things that stick out in our minds the most are the losses, right? The people that it didn't work for, the people it doesn't. But, you have a honking client list of people that it's working great for. And some people, it's not only just changed their lives, it has greatly improved their living situations. So, that our experience over within the infinite banking footprint's 22 years, long time. In the broader financial world, for me, like 30, 35 years. It's hard for me to say that. Actually, it'll be 36 years this month. Sometime this is April. Anyway. Your career's older than me.
Yeah, well, I still feel like a young guy, and I'm not going anywhere. My mentor graduated at 88, and he still had 4 unfinished projects. His mentor graduated, I believe, at age 85, unfinished projects. So that's probably the way I'm going to go, sir. I hope, anyway. A distinguished gentleman that was still very active, right? I forgot what I was going to say now. See, there's a sign of
and aging. Then there's the aging. No, fair.
Where was I?
In terms of the projects?
What I was saying. No, before that. Anywho.
I was paying attention to what you were saying, sir.
Thanks a lot. I appreciate that. I had a great point, and it'll come to me as soon as we turn the cameras off.
Fair enough.
Yeah. All right. Well, I sure don't want to end on that note.
So again, look, if whether a policy you currently have in force is not working for you, whether you need to make an adjustment, whatever it happens to be, it's that's something that you should be contacting. I would hate to say your current advisor for, because depending on what situation they've put you in, maybe you don't need to contact them. But yeah, our clients contact us when they have issues, and that's one of the first things we talk about with our clients. It's when issues come up, we can help you if you contact us early enough. If you leave us out of the loop and the problems compound to the point where you can't do anything, look, if I can't do anything, I can't do anything. But if you give me a chance early enough to help out when the problems start, my gosh, this could be a slight adjustment that makes the whole deal work versus, okay, 4 years later, all of this has gone to put and what have I done? Oh my gosh, I got to surrender. Maybe I have a taxable consequence and, I'm losing, this death benefit and this cash value, okay, you had an opportunity, and maybe that's where you're at right now. Is somebody listening is hey, this policy isn't what I thought I was getting. I need to make an adjustment. I need to, I don't know, stop paying premiums and I don't have the option where I'm currently at. Whatever it happens to be, reach out to us. Like, that's what we do. That's what we've done for 30 plus years. Like, we help clients and they have issues.
My career's older than you. I heard you.
Yeah, absolutely.
Look, where I was going with that is, when people don't win, I love to see people win. We like to see people win.
Yeah.
And when they don't win, right? And what you're saying is, if there's a problem, the sooner you reach out to somebody who knows what they're doing and has your best. If your best interest is to leave, we will help you leave with the most value possible.
Yeah.
No question about that. A lot of when people don't win with the infinite banking concept, and I don't know how many times I've written notes on that topic to do a robust episode on. When it doesn't work, when people lose money, and the activities that goes on that makes that kind of outcome apparent or probable, that has informed us over the years, and it's exactly why we don't or will not do some things, and why we will, do and how we do things.
Yeah.
And to me, and I'm pretty well known in the industry for certain things, my directness, number one. But I've said it many times, they keep inviting me back. If you ask me, I'm going to tell you, right? So don't be shocked when I tell you. And thanks for the invitation, right? It's look, no business. This is one thing I'm well known for in the industry. A lot of them can and will and have quoted me verbatim, right? No business is better than bad business.
Worse than bad business?
No business, zero business is better than bad business.
Okay, yeah.
Right. Bad business is not good for anyone.
No.
Any party. Bad business is bad business, and it doesn't have, pleasant results. And I understand that's kind of broad. But if will not do certain things, right? We prefer not to replace things, right? We avoid replacing things. We will not do these monstrosity structures. We'll not do them. And we get the, drive-by emails, like the order giver. It's like, oh, well, hey, I just need an illustration, and this is what I want to pay, and this is what I want. And you can tell who they've been listening to or what they've been listening to by
who they've been talking to, who they've reached out to already.
Yeah. And so, just send us an illustration, and this is what I want to see. I want to see this and this, and it's like, yeah, thank you.
Sounds like you need to go get your life insurance license and write it yourself, since you know what you want to do.
Listen, there's no one individual. It occurs regularly. However, they're probably well on their way.
Yeah.
Right. They've got the tests scheduled.
I'll tell you, from the business I've seen, the only business I've seen go wrong is people who started this with bad habits and didn't fix those bad habits.
What?
And maybe they were able to hide those bad habits from us, and we didn't see that. It's like, oh, this is just a red flag already waiting to happen. And with with clarity and being able to look back on certain cases, you go, oh yeah, well, no, duh.
I missed that.
I missed that.
They said this.
Look, they were telling me up front, they want to put everything in, take it all right back out.
It's like,
of course, they're in debt already. They're struggling with debt, and they want to eliminate the debt. So
those are red flags that we see.
Yeah, I'm just saying, at the end of the day, what I see is successful is people with good habits. I don't see those people fail. I just don't.
Yeah,
so,
look, rich people are rich because they have good. My daddy, your granddad, Papa, we lovingly called him. He used to say to me, and when I was young, kind of took it as an insult, right? Because I was poor.
Yeah, I love this. Yeah.
Poor people have poor ways.
Yeah.
And I'm like, why are you coming at me, bro?
Yeah.
It's like, it's so true. Rich people, wealthy people, I think rich is fleeting. Wealth is more than just money and monetary.
Yeah.
But wealthy people have better habits. They have the habits that have produced the wealth over time. And Nelson, you say, man, look, it all takes discipline. And if you don't have any, you better go dig yourself a hole and have somebody cover you up. If you don't have discipline, and Jim Rohn, oh my gosh, a mentor that I never got to meet, it's like, yeah, discipline. What you have today, and everybody knows this and you've heard it, but what you have today, what you put together now is a sum total of all of your previous habits.
Yeah.
Right. And I would continue to say, because I do want to be very encouraging, life insurance, wealthy people buy life insurance. And they have maybe no idea about the infinite banking concept and could care less about PUA or base or term riders and all. Wealthy people buy life insurance. I'm telling you, wealthy people buy life insurance. Now, I'm sure there's some guy out there that, paid 1,000 Bitcoin for pizza 15 years ago, and he's a mega gazillionaire because, Bitcoin or whatever. There's always the case that's like, oh, no, that's the worst thing ever.
Bitcoin millionaires or billionaires.
Yeah.
That happens. It's just like, what is your chances of being that person?
Yeah. It's
slim to none and slim's out of town, dog. Like it.
I love the people who's like, oh, life insurance is the world's worst place to put money. Those are the people that probably couldn't pass a physical because they're habits. They eat too much, they smoke too much, or whatever it is they do, had a bad experience with some jank, exotic product because, they wanted to get rich quick or whatever.
Yeah.
They're not wealthy, my opinion. I'm sure they exist. I don't know them and not really interested in meeting them.
Yeah.
The wealthy people that I know, they're open-minded to Bitcoin, and most of them have said, no, thank you. There's others that said, yeah, I'm all in on this or that. And if they don't currently own life insurance, but they are open to the idea and they're open, so they give it a legitimate look, they buy life insurance. That's been my experience.
Look, I'll take it a step further. When it comes to habits and things like that, I often hear, and I think that's part of the big wide world, what people are talking about nowadays, especially like in sociology and things like that. Where you start, like in life, is a big deal. Right? Whether you start poor or you start rich, like that's a big deal. Here's the thing. Good habits will change that, and bad habits will too. So let's say I start off very rich. If I have good habits, I will not only keep my wealth, I will increase it. If I have bad habits, that wealth will leave me very quickly. Yep. If I am poor and I have good habits, I will start saving, I will start retaining that wealth, and I will build that wealth and grow it over my lifetime. If I am poor and I have bad habits, well, you can just see the world. Like you can see that and just, I'll be in jail. I'll be, wherever. I'll be, I won't have money. I'll start off with no money and I'll never get it. And then that won't change. You want to change your family's life. You want to change your own trajectory, change your habits.
I agree. I think money flows to its highest value.
Yeah.
Its highest use. You can hear that and assimilate that however you'd like. Been my experience that money flows to its highest value. And if somebody knows what to, and I'm not talking about the evil, the cabal that runs the world. I'm talking about the you and me level and the discipline that creates the habits, and they're good habits. Everything good in nature, in my humble experience, is attracted to that because everything is really attracted to its highest value and its highest use, including money.
Yeah.
So, all right, that was a bit. Anything else you want to put a bow tie on or wrap up?
That was fantastic. That's the bow tie.
All right, perfect. So maybe we can make 2 parts. Maybe we can make 47 parts out of that. No, I had fun. Hope you enjoy listening, and we'll see you next time.
Or whatever the theme song goes.
Thank you for joining us on the Banking with Life podcast. If you're watching on YouTube, make sure to like and subscribe and click on that little notification bell. Otherwise, join us on Apple Podcasts and Stitcher for weekly content.